are in listen-only mode.
Hey everybody, Preston Bryn here with our weekly roundup for our trader user group. This is for the trading week ending August 19th, 2016. What I've got on the screen here is the E-mini S&P 500 futures, and you can see on here that we're just continuing this relentless grind off of the lows that we made back on the 27th of June. And it's just a hard bounce off that Brexit vote, and we're just continuing to grind. In fact, we've been in a grind mode really going back through the middle of July. So we're almost about 5 weeks into a solid grind here. Now, I've been telling our members that my target has been going all the way back to June, the 2200 area, not because it's a psychological number, but because I was looking at the combining both previous pivot highs and pivot lows and then running Fibonacci extensions and Gann extensions, time extensions off of these trades. I was able to look at this, and you could see this colored bar here. In fact, if we step out to a weekly chart, you can see on this weekly chart here, and we're hitting the target nicely. According to Gann, the timing series was around August 8th, and we actually came in and hit the target the week after this past week, and now we're sitting here just slightly off all-time highs, as you can see here at 2190.75. Excuse me. I'm still running around here running seminars over in Europe, but I should be back in the United States after the September Labor Day holiday weekend. So I'm looking forward to coming back. But as you can see here, we've had 1, 2, 3, 4, 5, 6, 7, 8 weeks of up moves, solid green candles here. Now this last one, this prior week, we did finish up, but just by a couple of points. So a lot of those out there that are candle aficionados may say, well, we've got a doji up here, so it looks like we may have some weakness. And I would probably agree with that. Again, I had said we were going to run up from mid-June right after or just post Brexit vote up to around 2200. And it looks like we've just about hit my target, short of about 9 points, 9.25 points. You can see the former all-time highs here sitting at 2134. I would not be surprised to see us come in and pull back to the 2134 area. You can see these blue lines coming in off the left-hand side of my chart, which represents volume over price. And you can see there's a ton of volume here underneath supply around our opening price for the year of 2037.75. I don't believe we're going to have, if we do have a little bit of a pullback, I don't think it's going to be very severe, anywhere from 2 to 5% max. At least that's the way the charts are indicating now. Now, of course, if the charts change, our members will be the first to know. But we've had this nice move up here, and we've played it very nicely. In fact, in our secret trader group for our members, we've been putting some trades on for the past 2 or 3 months now and have been successful in them. So, and I don't see why that shouldn't continue for the near term. And yes, I've heard all the arguments about why the prices can't stay up here because of overvalued there's no earnings, but the stocks are overvalued or richly valued, and I would probably agree with that somewhat. But keep in mind that with about 25% of global debt below zero, and just about every central banker is giving out money to their respective countries. And then here in the Fed, or in the US here, we have the Fed trying to talk a tough game, but I think the markets don't believe them very much, at least based on the data that we got out of the FOMC last week. So you can see here on this weekly chart, we've had solid up moves. But I do believe we're going to get a little bit of a respite here, a little bit of a pullback. And again, a pullback to 2134 would not surprise me at all, but that's not going to stop the uptrend, at least for the near term. For me, if we take out on this daily chart, excuse me, a key pivot low at 1981.50, that'll change my thinking. But until then, a little bit of a pullback, I suspect, is in order. Now, if we come and look at the Dow, you can see on the Dow here, we've got a really nice divergence that is set up. And in fact, it triggered here on the 18th going into the 19th. So I would not be surprised to see the Dow also pull back a little bit and show some signs of weakness. And you can see here as I put this key little minor pivot low in here at 18,170, we're at about 18.5. So we're about 400 points off of this key pivot here. I would not be surprised to see us come back and test that. There is a shaded zone under here that's more support for us at 18,000. And you can see all of this volume over price sitting right at around 18,004, and then down here again sitting around 17.8. So we've got a lot of support underneath us. We've got a large percentage of stocks over their 50 EMA, more over their 200 EMA. So near term, a little bit of weakness is in order, but I don't see too much of anything on the charts that would signify we're going to just have a major collapse for now. I am still on record as saying in the next 16 months, year to year and a half, we're going to see a 25 to 37% pullback in the markets, and I'm still sticking with that one. And if we look at volatility, look at how the VIX closed the week. It closed down at 1134. So the markets don't appear to be worried. Now that does concern me just a little bit, but you can see here, Wednesday, Thursday, Friday, these big red candles. So volatility, tried to make it up, but then buyers just stepped in and pushed the equity markets higher, and hence volatility back down. And we're near the 2016 lows for vol in the VIX at 1102. It's just a shade above the 10 handle. So vol is still extremely low. And for our members, I've been telling everybody, that, especially those that love credit spreads, I would not deploy more than 20-25% of our capital into a credit spread position. There are other strategies that we're running now that work out very well. In our Secret Trader, we're running some really cool things. If you're not a member, highly encourage you to come in and check us out. We're hitting month after month of successful trades, and you can follow along with me in our group. So anyway, that's kind of where I see volatility. Now, if we come down and we track treasuries, bonds is sitting on a key level. You can see right here, 170.28. And I said that if bonds can break this and hold it, I'll be more interested in pulling out shorts. I do believe we're starting to see a bottom in the interest rate arena. If we look at the 10-year interest rates, okay, which really is what drives the U.S. mortgage market, let's put it on a weekly chart here so that you can see. We've clearly been in this down mode for quite some time, and you can see here we're starting to find a bottom in the 10-year interest rates. And you can see for the year, our low was back here at 1.33, made back in July on 2016. And we're trying to find this low, but we're trying to consolidate. If we come back to a daily chart looking at the interest rates, you can see here how we're finding this bottom here. We're getting some divergence down here, which would suggest that the near-term action for interest rates could be a little bit higher, hence the bonds lower, okay? Or treasury notes and bonds too. And if we look at the currency market, well, you can see here in the British pound, we're trying to find a low here. We've got this divergence here. I've been short the British pound post the Brexit vote. In fact, we got short the night of the Brexit vote and rode it all the way down. And then I just flipped over to longs in the British pound near term. I'm one of those that a little bit more of a contrarian. It's an overcrowded trade right now. And you can see right here at 135.02, I don't think the pound is going to get much higher than 1.3502 until we get a lot more clarity on just how the Brexit vote will or will not hurt the British economy. But I believe it's not going to hurt it as much as people think. Remember, the markets always overcorrect, both to the upside and the downside, and I think this has been an overcorrection to the downside for the pound. So I rode this to the downside. Now I flipped over. I'm looking at taking some near-term profits on the upside, but we'll see. We had the Prime Minister of Great Britain come out Friday and talk down the pound a little bit by saying that they may delay by a year or two, another year, some of the details around the Brexit, orderly Brexit process. So that tended to push the pound down a little bit. But I do believe that down here is clearly buying opportunities. Now my target for the pound, really, to be quite frank, was down around 1.26, and we may get down there. If we do, I'll be a bigger buyer of the British pound. I do believe that the UK economy is going to be a lot stronger than people think, and that's going to be very bullish and supportive for the pound going forward. The Japanese yen. Well, the Japanese yen, is as much as Shinzo Abe and Kuroda, who runs the Bank of Japan over there, want to drive the yen down. Look at the yen, and we're up near the 2016 high price here. Now, I've been telling our members here, selling bear call spreads out of the money here with FXY, or if you can go into the Japanese yen and trade the futures, that makes sense, or being long yen dollar. Because the dollar's been very weak lately. I've been long the pound dollar and long the euro dollar. And you can see here with the yen also moving much stronger. And as by consequence, you can see the dollar outside of Friday, really since July the 25th, has just been in a downward swoon. And I think that's going to continue going through October. Keep in mind that in October, China and the yuan becomes official. They've been granted strategic reserve rights, special drawing rights, SDRs. So that means a lot of countries, and they're already starting to do it now, they're going to be selling some of their portfolio of dollar and pound and euro and adding yen in proper ratios. So that means that's going to be more supportive, the Chinese yuan, rather. It'll be supportive of the Chinese yuan, a little bit bearish the dollar, at least near term. So going through Q4 of this year, I see some of that going on as well. And then if we look at the utilities, which is really, it kind of runs with the bond market. You can see the utilities is off their all-time highs, and which happens to also be the 2016 highs. Now, utilities has been leading the U.S. markets higher, and you can see this upsloping trend line that really started in middle of December of 2015. If we break this to the downside, for sure, we're going to see the bonds break and fall, and we're going to see interest rates start to slowly rise. So it'll be supportive of a higher interest rate environment. And also, if we look at oil, oil tends to be an inflationary kind of thing. So the higher oil goes, you're going to see interest rates start to move higher with oil, and bonds move lower, because it tends to be a kind of a sign of inflation. But you can see oil here, the oil futures, were off the 2016 open price, and we're moving up towards the 2016 high of 51.67. Now, a big part of this move, there's only been 2 days, and this is a daily chart, there's only been 2 days since the beginning of August that we've had a downtick in oil. Otherwise, oil every day in the month of August through the 19th has been an uptick. Again, on the belief that the Saudis and all the other OPEC and non-OPEC oil-producing countries are going to come together and stabilize the oil market, or at least agree to production freezes. Now, the funny thing about that is, right now, each of these countries are at their maximum output. So I think for them to do a deal while they're at maximum output, I don't think they're going to be producing any more oil. So there's a higher probability of them agreeing now than there was before when their output was lower. But we'll see. You know, these guys are trying to like herd cats. I don't know what's going to happen. I do believe, though, that oil, the near term is higher. We can get a little bit of a weakness up here. I don't think oil is going to get over 55 a barrel in 2016. But if we look at a weekly chart, one interesting thing that tends to show up here, let me move this out just a little bit here. And it's not ideal. And let me just see if my drawing tool works here on this weekly chart for oil. But it would be supportive of oil prices running higher, right? I mean, that's what we would see here. You can see if I were to draw a line like this, right? And then you could see here is a left shoulder. Here is a head. And then the formation of a right shoulder. So you got left shoulder, you got head, you got right shoulder right here, okay? and then a break here of these 2016 highs would suggest a move of a points, right? And this point move, this 25-point move would put us up in this area here around 75. Now, this is a weekly chart, so understand this would take about 1 year to play out, okay? So, but if oil moves up into that area, it'll be highly inflationary, and interest rates will be up at least another 50 to 75 basis points. If we get up in this area here, we'll have 2 more rate hikes. So just be on the lookout for this. For our members, we'll be following it very closely, and we'll see how this thing plays itself out. So that's a little bit about what I'm seeing right now in the oil market, okay? And then if we come over and we look at agriculture, we've had 5 successful trades in a row on soybeans. We may be entering another one here. We've had the crop report. I believe, and let's go back to a daily chart here, soybeans is going to produce record crops. So I think we could have a situation here where selling call spreads above the markets here in soybeans makes sense going out in time. You can see the 2016 open, 2016 high. Soybeans is more elevated. If we look, it's the same thing with corn and wheat. They tend to fall together. If we look at corn, you can see corn is already down around their 2016 lows, well below the 2016 open price. And if we look at wheat, you can see something similar. We're up, but we're down, and it would suggest that a lower price is necessary for these things. So that's kind of where we're looking now. There's some other things that we're playing in the soft market and the meat market, but otherwise, for those of you that are non-members, I hope you come in and check us out. We've got some really cool things going on, especially in our secret trader room. And then for those of you that are members, I will see you this Sunday night for our upcoming weekly market watch. Otherwise, everybody have a great summer weekend, and I will be in touch with you. Ciao, everybody.